Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Mike Padawer. Mike is a long-term care insurance expert, and thanks for joining us today.
Thanks, Mark.
So I know you have some unique strategies for moving money from annuities to long-term care, but first of all, how did you get into this industry?
Well, back in 1991, I was actually started working for what's now one of the larger asset-based long-term care planning firms, One America. But back then, it was known as Golden Rule.
Hmm.
So I've been in and around. That's where I started, and in 2011, I started a Nurse Advisor Services Group to be kind of the advisor's advisor for long-term care planning strategies. And here we are, almost 9 years later.
Okay, so I guess you began this when you were really young in the long-term
Like
care world, but you've
six,
seen a lot.
6 or 7. I have a young face.
So tell us a little bit about the clients you work with. Who's your typical audience?
Our typical audience is actually financial advisors, estate planning attorneys, CPAs, fee-based planners, people who are working with the end user being the general public. So we're kind of, like I said, the advisor's advisor for long-term care planning strategies.
So I know you have kind of a unique planning strategy that you wanted to share today. First of all, tell us about who the referring partner was, and then we'll talk a little bit about the clients and their needs.
The case we're talking about now is about a year ago, because it's open enrollment season right now. It came to mind. He was working with about to turn 65-year-old woman and her husband, so Tim and Janice, and they were discussing their they were discussing their Medicare supplement needs, and they had a parent that was needing long-term care, so it came up in the discussion. And when they realized, once again, what the limitations were with Medicare, they wanted to do some long-term care planning. So that's when the call came to me.
Interesting. Okay, so as often it does, came from a personal experience, first of all. But how did the advisor think of you? Kind of what questions do you ask of the client that made them think of a solution that you had to offer?
We always try and encourage advisors to ask how a plan is going to be funded. So in this case, or in all cases, basically the question is, absent the long-term care plan, which of your assets would you have to tap first in order to pay for care if that care is needed? And in this situation, the client said, well, I have an old annuity, an old non-qualified annuity that we would use for that purpose.
Interesting. Okay. And what kind of generally speaking, what can you do with an old non-qualified annuity to fund the long-term care need?
In 2006, Congress passed what's called the Pension Protection Act. And one of the aspects of the Pension Protection Act, which we call it the PPA, kicked in 2010 with respect to non-qualified annuities, after-tax annuities that are the people use for supplemental retirement planning. And what the PPA now allows people to do with those old annuities is move them through a 1035 exchange from one carrier to another to create a long-term care plan and effectively use the highly appreciated or the gains in that policy to come out in the new policy tax-free for long-term care planning purposes.
Okay, so this is money that's not in an IRA or 401k. So like you said, after
Correct.
tax money. And the idea is that these funds oftentimes have gains in them. So tell us a little bit about Tim and Janice's annuity. What did that old annuity look like in terms of how much they put into it and how much gains it had?
So originally the annuity was about $100,000 deposit. Today it was about $175,000. So that means that there were $75,000 in gains. So when we explained, how the current situation would work, that with $75,000 in gains and the accounting rule known as LIFO, last in, first out, that about $11,000 or $12,000 would be taxable in the event that they took it out today for long-term care planning purposes. So two things would happen. Number one, by moving the 175 to the new annuity, it would allow those dollars to come out tax-free. The other thing that would happen is, if long-term care would be needed, we'd turn $175,000 into over $500,000 of long-term care benefits.
Wow. Okay. So what allows the carrier to offer so much more in benefits under the new annuity than they did under the old annuity?
That's a good question. A lot of carriers today offer, life death-based long-term care plans, and this is an annuity-based long-term care plan. So on top of the dollars going in that are your dollars, there's also a long-term care insurance component, basically an extension or continuation of benefits rider attached to that annuity that creates those extra dollars to come out when they're needed for long-term care.
Okay, and then I guess what are the trade-offs of giving up the old annuity? Obviously, there's no free lunch, but what are they giving up and what are they getting from this?
It all depends on where the old annuity is. If it's in a fixed annuity, you might be giving up a small amount of interest versus the new annuity that might not be paying as a good an interest rate. If it's a variable annuity, you're taking money out of the market and putting it into a fixed product. But again, what we're really doing is saying, to create a long-term care plan, what's the most efficient and effective way to do it? And if you can move money from one pocket to the other, essentially for zero out-of-pocket cost, you create a nice long-term care plan. So the benefits far outweigh the what you might be missing out in opportunity cost.
Right. I'm picturing with today's low interest rates, you may not even be giving up much cash accumulation to get 3x of what you would have gotten otherwise. That's a pretty good trade-off.
Right. And we also do the analysis, and we can show based on, certain percentages, we can actually show the client, to get this amount of coverage, it would take you 472 years to do it,
Right. So it's a pretty good trade-off there.
Correct.
So let's talk about the long-term care rider component. Is this an underwritten annuity or is it guaranteed issue?
It is underwritten, so there are certain knockout questions and certain situations that you wouldn't be able to qualify for 3 times the coverage or 2 times the coverage, or whatever the amount would be. And that's going to be predicated obviously on health. So there's certain things we can do and can get through and certain things we can't. And again, those are the questions that every advisor, everyone talking to a potential client about long-term care needs to remember. It's going to be underwritten.
Right. And I'll say probably the underwriting is not as difficult as it might be in a traditional product or a life-based product because, 3 times is what the carrier is going to be paying out, correct?
That's correct. And the first thing that you always are mindful of is that the first dollars coming out of these types of plans are going to be what? It's going to be the individual's initial deposit. And that just goes back to the theory or the actual implementation or the discussion of where the money is coming from. Because this individual or most individuals using these plans are starting off with, I would be using this pot of money in order to pay for care. All we're doing is moving that pot from here to here, but increasing the amount of available dollars in order to pay for those care needs in the future.
Okay. What typical ages do you see people doing this usually?
We're seeing it younger and younger all the time. I mean, we're seeing annuity cases and a lot younger than we used to. It's primarily still going to be in that 60 to 70-year-old range. The annuities work really well for that 70 or 75-year-old who on a life chassis or a traditional long-term care insurance plan wouldn't be getting a whole lot of bang for their buck. But if we can take X amount of dollars and provide 3 times X in long-term care benefits, that's a great scenario for a 75-year-old.
Right. I know you were also telling me that you can do this from an annuity into a traditional policy. You can do it from a life insurance policy into the annuity. Right. There's a lot of different variations of this theme.
Right. So quite often what we're seeing is, Mr. Jones has a nice life insurance policy from Mama Mutual, and it's got lots of gains in it. So he's 65 or 70 years old now and doesn't need the death benefit like he used to, but he's got $200,000 in gains in the policy. So we're able to take that cash value, move it to the new policy, and we can actually add what we call an additional insured or an eligible insured to essentially do a single life exchange and create a joint life long-term care plan for little or no out-of-pocket cost.
That's so awesome. So there's all kinds of ways to do this. Make sure you work with an insurance expert like Mike here, that you do it the right way and you find the right vehicle. But thanks for joining us today. I really appreciate you sharing your insight here.
It's my pleasure. Thanks for inviting me, Mark.